Hi, everyone. I'd like to welcome you to the first in our series on financial risks, innovation and inclusion. This is something that we thought would be very valuable in this time of the impacts of COVID on the global economy. I'd like to start by thanking UC Investments and the UC Chief Investment Officer, Jagdeep Bachar, for their collaboration and participation. We're really looking forward to that as well. And I'd like to thank Christian Palma, Joni White, and Diana Hogue of University of California for making all the arrangements. At this stage, with 6 months into the pandemic, you're probably all familiar with Zoom, but I'll just mention again that this is, we're using the webinar tool, so you won't be able to, your videos won't show up, and you'll be able to ask questions through the Q&A feature. And we will collect all the questions and have the Q&A after the presentation. And I'd like to quickly introduce our speaker. We're very pleased to start off the series with Professor Rajeswari Sengupta of the Indira Gandhi Institute of Development Research in Mumbai, where it's late night, and we're very grateful to her for participating and helping us kick off the series. Rajeswari is an alum of UC Santa Cruz, so we're really happy about that. And since going back to India, she has been very involved in both academic and policy work on the Indian economy, especially with respect to monetary policy and financial sector reform. So she's really the perfect person to tell us about what is happening in one of the largest countries and economies in the world as a result of the pandemic. So Rajeswari, over to you.
Thank you so much, Nirvikar. Let me just start my screen share. And thank you to CAFIN and UC Investments for giving me this opportunity to present what I consider a very, very important topic, of course, as to how one of the largest emerging economies in the world is now dealing with the pandemic shock. And it's a pleasure and a privilege to come back and give a talk at UCSC, the place that I graduated from. So I'm doubly pleased as a result of that. So without further ado, the title of my talk is India's Economy, What is the Long-Term Damage of COVID-19? Of course, it's a very broad topic. So what I plan to do is I'll talk for about 25-30 minutes to give some kind of a summary of the main issues, and then hopefully be able to use the Q&A time to answer your questions and dig deeper into some of the issues. So as we all know, of course, we are in the middle of a global pandemic, which is inflicting two kinds of shock on all the affected economies, a health shock and an economic shock. And the ways to contain the spread, such as social distancing, etc., are intrinsically problematic for the economic growth of the countries. And in this, of course, India is not unique. However, the problem in India could be more acute and longer lasting because the economy was not doing particularly well in the run-up to the crisis. And it's not surprising, perhaps, that in the April to June quarter of 2020, the GDP growth rate of India was minus 24%, making India one of the major economies that recorded this kind of a GDP contraction. So my talk today is going to be split up into 4 sections. I'll spend some time talking about the precarious condition of the Indian economy before the pandemic hit us. Then I'll spend a little bit of time talking about the ongoing problems and the policy actions that have been taken in response to the crisis. And then I'll spend some time on what I consider to be the future prospects of the economy. The economy before the COVID-19 outbreak, the growth momentum of the Indian economy had been slowing down rapidly over the last few years. According to official data, the GDP growth rate declined from 6% to about 4% right before the pandemic. This is the lowest growth rate since the global financial crisis. However, this data is subject to official data problems. There have been a lot of measurement issues in the official GDP data. So it's possible that the actual growth rate before the pandemic was lower than what was reported in the official data. The growth slowdown was primarily triggered by an overall collapse in aggregate demand. Notably, private sector investment has been declining since about 2014-15. India's growth story is often considered as something that is triggered by or driven by consumption, but per capita personal consumption expenditure in real terms declined by close to 4% between 2011 and 2017, and this was the most severe decline in the last several decades. And of course, partly because of the global economic condition and also because of India's domestic slowdown, exports of goods and services had also been falling over the last few years. And the net result of all of these has been that it has been whatever growth we have had has essentially been a jobless growth, with unemployment rate, although it is highly underreported, but still the official unemployment rate reached the highest in the last 4 decades. This graph shows the year-on-year growth rate of GDP as reported by the National Statistical Organization. And as you can see, from 2016-17 onwards, there has been a pretty sharp decline in the GDP growth rate. However, this, as I said, conveys only part of the picture because of measurement issues. If I now move on to the next graph, this shows the year-on-year growth rate in the total investment projects that have been under implementation, both in the private sector and in the government sector. This is data collected by a private organization. And this shows that there has actually been a secular decline in investment projects since 2010-11. There was a little bit of a pickup around 2014-15, which is when the current government got elected to power. But since then, it has been stagnant. And in the last couple of years, there has been a decline in the growth rate, fall in the growth rate. Now, another indicator of business sentiment is the new announcements of projects by the private corporate sector. And when we look at in levels in terms of rupees trillion values, we find once again that the total, the projects that have been announced new by the private sector has been declining from 2010-11. There was once again a temporary pickup around the election year of 2014-15, but since then it has been practically stagnant. So this gives a picture which is worse than painted by the official GDP data, that the Indian economy, particularly the private sector, has not been doing well at all in the run-up to the pandemic. A big reason why the investment has collapsed in the private sector is because the private sector has been heavily leveraged, and the firms have been struggling to deal with balance sheet stress. A lot of the loans that they had taken during the pre-global financial crisis period turned bad in the years afterwards, as a result of which the banking sector, and it's important to note here that the Indian economy is heavily dominated by the banking system. The banking sector was overwhelmed by high levels of bad loans, what we refer to as non-performing assets. So the twin balance sheet problem in the private corporate sector and the banking sector became a very, very important reason why private sector investment collapsed and why we ended up having a jobless growth. This also got reflected in the growth rate of commercial credit, which fell to the lowest rate in 6 decades by March 2020, which was right the time when the pandemic started becoming serious in India. This is a graph that shows the share of bad loans as percentage of total loans in the banking sector. And as you can see that right from 2010-11, this has been going up, particularly from 2015. It became really a sharp increase, and it actually hasn't come down much. By March 2020, by December 2019, actually the total bad loan percentage was only down to 9%. So the banking sector continues to be in deep trouble, and private sector also has not come out of the woods, in fact, far from it. While the banking sector was struggling with the non-performing asset crisis or the bad loan crisis, the non-banking finance companies stepped in a big way. They, in fact, increased their lending between 2014 and 2017. In fact, their lending doubled compared to the pre-2010 era. However, there was a big default by a large non-banking finance company in September 2018, which was also followed by troubles in several other such non-banking finance companies, as a result of which their lending fell dramatically. And this was very important for the consumption story because NBFCs lend a lot to the retail sector, to the micro, small, the medium enterprises, the informal sector. So all those sectors got very severely affected. There was also a widespread credit crunch because the banking sector and the bond market were heavily exposed to the NBFCs. And with this crisis, which was dubbed as a mini Lehman Brothers moment for India, with this crisis, there was a very high risk aversion in the banking sector and the bond market as well. And while we got hit by the pandemic, we were still recovering from that crisis in the bond market and the NBFC sector. Over and above the events that have been happening over the last few years, there are some structural vulnerabilities which I think make India particularly weak going into the pandemic. For example, India has a vast informal sector which employs close to 90% of the working population and contributes more than 40% of GDP. So it's a very large informal sector, which, however, has been recovering from 3 previous shocks already. So as many of you may know that in 2016, the government announced a demonetization whereby more than 85% of the currency in circulation was declared illegal overnight. That disproportionately affected the informal sector, which is primarily cash-based. There was also an introduction of the goods and services tax, which was done to simplify our indirect tax system, but the implementation was not done in a very efficient manner. That also affected the informal sector enterprises. And lastly, as I mentioned, the Nbfc crisis that started in 2018 came as a third shock for the informal sector. So you can imagine that the sector has been badly battered by a series of shocks, and then comes the pandemic, which of course is going to hurt them even more. Also, household leverage went up significantly over the last 10 years. In fact, it doubled in the post-2008 period. Households were essentially borrowing from the banks and the NBFCs to maintain their standard of living when their incomes had been falling as a result of the slowing growth of the economy. And over and above all of these, we have an underdeveloped and inadequately funded public health system, which of course has proved to be very costly for us over the last few months. Added to the structural problems are limited policy levers. The fiscal situation of the central government as well as the state government has been severely strained over the last few years. In fact, the fiscal deficit just last year of the central government at 4.6% was the highest since 2012. That was just right after the global financial crisis, when the government had given a lot of fiscal stimulus. Monetary policy transmission has always been a problem in India because of structural difficulties, and that was particularly weak before the pandemic hit us. The Reserve Bank of India, which is the central bank, has been conducting monetary policy expansion. It has cut the interest rate significantly. It has also injected a lot of liquidity, but there has not been much impact on the credit growth from the banking sector. Of course, as I mentioned, partly because the banks, badly battered by the bad loan crisis, have turned highly risk averse, because the attitude in India was that the bad loan crisis was a problem of the banks' lending practices, and therefore the banks need to be penalized. So that in turn heightened the risk aversion of the banking sector. And also there was a fall in credit demand because of the slowdown of private sector investment. This is a graph of the repo rate, which is the equivalent of the discount rate in the US, which is the rate at which the central bank lends to the commercial banks. And as you can see from 2019 onwards, it has been consistently going down because of the monetary easing done by the Reserve Bank of India. This is the 91-day Treasury bill rate, which is a summary measure of the overall monetary policy stance of the Reserve Bank of India. And this also shows that there has been a consistent attempt by the RBI to provide a monetary stimulus to do monetary easing, but none of these has translated into an increase in bank credit growth. This shows the year-on-year growth rate in commercial bank credit. And as you can see, particularly from late 2018, early 19 onwards, there has been a very sharp decline in commercial bank credit growth. In fact, right now, the bank credit growth is at an all-time low of 5.3%, which is the lowest in more than 6 decades. So with that as the background, so that was the condition of the Indian economy as we went into this massive shock triggered by the pandemic. What has been the nature of the problem in the ongoing crisis? The pandemic started pretty much in India around March 2020. On March 24th, around the time when the total number of confirmed cases in India was not more than 500, the government announced a nationwide lockdown with only 4 hours of notice. And at that point of time, this was considered the most stringent lockdown announced in any country, barring maybe a couple of exceptions. The first phase of the lockdown continued till the middle of April, and it was extended multiple times till June. Since June onwards, there have been phased relaxations of the lockdown, and these were ramped up significantly last month. And right now, in fact, we are in what is called unlock phase 5, where the government has been progressively relaxing all kinds of restrictions on the economy. And it's also worth noting that while the lockdown was nationwide and seemed very strict, it wasn't really enforced in a very, very strict manner because, as you can imagine, India is a vast country, and particularly in the rural areas, there really wasn't much of a lockdown. Now, despite all the efforts by the government to impose a lockdown, to do mobility restrictions, the number of new infections continues to rise throughout the country. Currently, I think it's about a little bit around 6 million cases. But of course, as a percentage of the total population of India, that's a very, very small percentage. Now, how is the shock affecting the Indian economy? It's the twin shock of the pandemic and the lockdown operating at 2 levels, similar to most countries, I would think. One is it's, of course, creating massive supply side disruptions because of the lockdown. And secondly, it's triggering large-scale reductions in aggregate demand. In terms of the supply side constraints, all factors of production have been facing disruptions, be it capital, be it labor, etc. For instance, when the lockdown was announced, as many of you may have been following in the news, there was a mass exodus of migrant workers from the urban areas back to their native villages because it was just announced with 4 hours of notice and they had no preparation whatsoever, but they ran the risk of losing their jobs. There have also been significant disruptions in credit availability. As I just mentioned, our banking sector has not been in the best of health, and already credit growth was slowing down before the pandemic hit us. And with the pandemic and the uncertainty associated with it, the credit situation has become significantly worse. International trade restrictions, that's something that all countries are facing. And of course, domestic logistics issues, because there are our trains are still not running, and all kinds of state-to-state transportation had a lot of constraints in the initial few months. What is happening now with the relaxation of the lockdown is there is some pent-up demand that is getting released, but of course that is not at all a harbinger of good times to come. In fact, it's just something that's happening as a result of relaxations announced by the government. Currently what we are seeing is that the supply side constraints, which seem more dominant, seem unlikely to get resolved soon. And this particularly gets reflected in the inflation story. This is the graph of the consumer price index inflation that is tracked by the Reserve Bank of India and by investors and markets alike. We have an inflation targeting framework in place since about 2015-16. The red line shows the inflation target of 4%, but it's a flexible inflation target. So we have about 2% above and below 4. That's the band. And as you can see, for the last several months, inflation has been above the upper band of 6%. And that has become a serious worry for the central bank, which has paused any further rate cut in its monetary policy. On the demand side, as can be expected as a result of the lockdown, there has been a reduction in discretionary spending, and also because of the uncertainty associated with how long the pandemic is going to last, etc., what's going to happen with the job scenario. There have been quite a bit of job losses, especially in the migrant workers and daily wage earners section. Also in the urban areas, we are seeing more job losses in the urban than in the rural areas, and reduction in salaries as well, all of which is going to play out in the medium term in terms of reduction of purchasing power. But currently, as I said, it seems the supply constraints seem more problematic than the demand. And we are in a classic supply shock, which is manifesting itself through a high inflation and low growth, what is called a stagflation by economists. On the external sector, current account deficit is what we have been living with for the last several years. But in the last few months, it has turned into a surplus. Of course, that's not really good news, because the only reason we have a current account surplus now is because imports are falling less than exports. And that's, of course, because the domestic economy has been slowing down. And the exchange rate has been appreciating of late. So that's the external story. What have been the policy actions adopted by the government and the Reserve Bank of India so far in response to the crisis? So let's just take a quick look at that. RBI has, which is the Reserve Bank of India, has done its fair share. It did further reduce the policy rate to 4%. So as I was showing you in the graph, the policy rate has already been coming down before the pandemic, and the RBI did further easing of monetary policy to help the economy. It has also injected vast amounts of liquidity into the system, sort of to encourage the banks to start lending, and also to push down the yields of the government bonds and make it sort of cheaper for the government to borrow. And it also imposed a moratorium on repayments of loans over the last 6 months. And the moratorium is just about to end right now. However, given the fact that there has been a complete collapse in the demand for credit, which we saw, as I said, before the pandemic as well, and it has just got aggravated now, and also because the banking sector in general has been highly risk averse and stressed, we are not seeing any uptick in credit growth whatsoever. So transmission of rate cuts was weak earlier as well, and is likely to be worse now, which further limits the capacity of monetary policy to revive growth in the current scenario. On the fiscal side, the story is no better. The government, as I said, has already been struggling with its finances. It did announce a package primarily targeted towards low-income households and what we call the medium, small, and micro enterprises. However, the actual stimulus from the budget is hardly more than 3% of GDP in comparison to the large stimulus amounts given by many of the developed countries like US, for example. But that's not surprising because, as I said, the fiscal situation of the government has not been particularly good. In fact, for this year, the fiscal deficit of the general government, that is central plus state, is projected to be around 12 to 15% of GDP, which is very high, which means there is no fiscal space for any additional spending this year. On the debt resolution, ordinarily we would only talk about monetary and fiscal policies when we're talking about reviving growth. But because in India we have been dealing with a twin balance sheet crisis, the debt resolution aspect becomes extremely crucial. The Reserve Bank of India has announced a restructuring scheme for stressed borrowers recently. However, the insolvency and bankruptcy law that was implemented in 2017, that now remains suspended, which creates further uncertainty around how debt resolution is really going to take place. So now moving on to the last part of my talk, which is about the future prospects. What could be the long-term damage and what could be the green shoots for the growth revival, the way I see it. In the medium-term growth outlook, by all estimates, it seems the projected growth for this year could be anywhere between -7 to -12%. So it's going to be the most severe GDP contraction that we have seen in modern times. And it's possible that by next year, as the pandemic sort of recedes and the lockdown is relaxed, the economy may get back to where it was in 2019 in level terms. But that is just the recovery of output, and that's not really growth. Which means we may end up losing 2 years of growth, which will be quite severe for a developing country like us. Also, given the extent of the shock, it's possible that potential growth rate may decline because it may take several years for this entire mess to get cleaned up. So I'd like to focus on fiscal, monetary, and the banking sector. The fiscal deficit, so this is based on my own analysis of what the fiscal scenario looks like. For the central government alone, for this year, the baseline scenarios is something around 7.9% of GDP. That's how much the fiscal deficit is going to be. And over and above this, you have to add the state level deficit and also many off-balance sheet items, because of the last few years, the central government has been pushing much of its spending off the budget. And if we take all of that into account, it goes into double digit. What that means is without any additional government expenditure from last year's level, and which means not even taking into account whatever fiscal stimulus has been announced this year, This level of fiscal deficit will lead to a debt to GDP ratio of more than 80% in the medium term, which is one of the highest debt to GDP ratios that we will have in the last several decades. And this is only if the economy experiences a strong recovery. So here I'll show you two projected paths. It starts in 2019 when the actual debt to GDP ratio was around 75%. This year it's projected to be, let's say, around 82%. But then depending upon whether the recovery is going to be strong or weak going forward, if you have a weak recovery over the next 4 or 5 years, the debt to GDP ratio could exceed 90%, which is extremely high for us. And in a strong recovery case, also, it's not really very encouraging. It's just hovering around 80%. And mind you, this is not taking into account any further expenditure that the government will do over the next few years. So this seriously limits the capacity of the government to provide a fiscal stimulus to revive growth. On the banking sector, the projected bad loans, and this is forecast by the Reserve Bank of India, the bad loans in the banking sector is supposed to be around 12 to 15% of total loans by March 2021, which means it's going to exceed the peak of the last bad loan cycle that I was talking about. So it's pretty severe. The restructuring program that the RBI has announced is mostly, it's just going to postpone the problem because you're just rescheduling the payments. You're not really solving the problem of the banking sector. And it's highly possible in a year or two, we'll see the bad loans and the capital shortage of the banks get significantly worse. And all of these, of course, limit the bank's ability and willingness to lend to the private sector, thereby further adding to the slowdown in the commercial credit growth. And the third concern that I think is important to flag is that CPI inflation has exceeded the target for several months now. And although it is a supply side related inflation, which makes it very difficult for monetary policy to control it, but at the same time, inflation expectations have been rising. And the fear is that if monetary policy does not act now and inflation expectations get entrenched, then it will become extremely painful for the RBI to bring inflation down. And it may have to reverse the accommodative stance at a time when growth needs to recover. So that becomes like a double whammy when next year, let's say, our growth needs to get revived. So what can be done? As I said, given the limited policy space and given the nature of the shock, I think very little can be done by macroeconomic policy. There is not much room for a macro maneuver, so to speak. In the private sector, it's inevitable that many weaker firms will just have to shut down. And what the government needs to do is to prioritize structural reforms in order to address the issues that have been slowing down growth in the pre-COVID period. I think that's what the government needs to expedite, instead of focusing on short-term policies, because there's not really much that the government or the RBI can do at this point. I've listed some of the structural reforms. There's already some reform efforts taken by the government in the agricultural sector, as well as in the labor market. But I think what is also very important is to fix the twin balance sheet problem that has been lingering on in the economy for the last 7-8 years. And for this to happen, I think it's extremely crucial to bring the insolvency and bankruptcy law back from suspension and to fix whatever problems were affecting its implementation. Because without the IBC, without the bankruptcy law, we cannot make progress on the debt resolution of the private corporate sector. Also, we need to recapitalize the banks. 70% of the Indian banks are owned by the government, which means the government needs to recapitalize these banks. And these are the banks which have the highest amount of bad loans. So the banks need to be able to take haircuts now, as opposed to pushing the bad news to some future date and then everything explodes 2-3 years later. And while the fiscal situation is bad, I think it's now is the only time the government can recapitalize the bank, because going forward, the fiscal situation may become even worse. Second, of course, is to fix the fiscal mess. This is more a medium-term program where there has to be a credible program to increase tax revenue and simplify tax administration, to minimize the hassles faced by the corporate sector and the investors, and to bring about transparency in fiscal accounting. As I said, over the last few years, the central government has been pushing a lot of the spending off budget, which creates a lot of opacity around our budgeting, which makes it difficult for the markets to understand what is the true nature of the fiscal problem. I think it's extremely important for the government to come out cleanly about what exactly is the depth of the fiscal mess. Third, of course, as I said, it's important to address the inflation problem. While it may seem temporary because of the supply constraints, But given the nature of the supply constraints in India, they're unlikely to get resolved soon. And while we do have an inflation targeting framework, it's extremely important to uphold the credibility of the framework rather than dilute its importance. And lastly, I think one opportunity that the government should encash on, instead of looking inward, which I believe a lot of countries, including India, have been thinking about, I think we do have an opportunity to facilitate exports of goods and services, because when domestic demand is drying up, one source of demand that the private sector could be looking at is exports, especially in a scenario where China might be withdrawing a bit from that sector, creating some kind of an opportunity for the Indian firms. This is my last slide, so I will end with this because I don't want it to be all doom and gloom. There are some green shoots for sure that I want to highlight. For example, the private sector may respond through consolidations and mergers and acquisitions. Firms which have deep pockets will increase market share at the expense of the weaker rivals. And this is something that we're already seeing. For example, firms which get private equity investment are able to increase market share. And also we have all received a crash course in technology. So technology adoption is probably going to be boosting productivity in the private sector going forward. Second green shoot is the rural economy. Fortunately has been doing well, rather well in comparison to the urban economy. We have also had good monsoons, which means the agricultural sector might perform well. We may have a bumper crop, which is very important for a country like India. And this may also push down food inflation a bit and could also be a source of demand revival coming from the rural sector. Third is we have never really had a history of consumer credit bust. So while household leverage had picked up and a lot of retail loans might be in trouble now, but we're also seeing data from the credit bureaus that loan repayment from the retail sector has picked up compared to April-June quarter, which is a good news. So that could be another area where demand might snap back faster than we imagined. Fourth, I think it's extremely important because we have all gotten used to a work from home model. And if that's the model that seems to be the norm right now, I think it presents a great opportunity for India to benefit from global outsourcing. Because if you have to employ somebody, instead of employing and paying higher wage sitting in, let's say, in America or UK, why wouldn't you hire somebody sitting in India, but at, let's say, half the cost? And I think that presents a great opportunity for India, almost like a second outsourcing boom, and to take part in that. And lastly, I think in terms of the pandemic itself, it seems that India may achieve herd immunity even before the vaccines become available, and sooner and faster, because as I said, the lockdown has been relaxed for quite some time now. People are moving out and about. Yet the number of cases as a percentage of the population is really low, and particularly the death rate has been one of the lowest amongst all the major countries that have been affected. So that is definitely a positive news. And this itself may pave way for a faster economic recovery. And of course, all of these are subject even more to the reforms that I mentioned adopted by the government. So with that, I would end my talk, and I'm happy to take your questions and comments. Thank you.
Rajeshwari, thank you so much. That was an amazing summary, I think, of the state of the Indian economy. And I think I don't think anybody else could have done such a great job. So thank you. There are several audience questions, but I'm going to start off by asking you, could you put a number to actual growth over the next year or two and the impact on potential growth? You know, we've seen figures for potential growth of 8% has been typical. Do you see that coming down? And what's the, when are we going to get back to that potential growth?
I think if let's say we grow at about minus 10% this year, that's the extent of contraction. I think in a reasonably optimistic scenario, next year we are going to bounce back to exactly 10% again, because there'll be a base effect, and all of this release of pent-up demand is going to take an effect. So I think next year could be 10%. In an even more optimistic scenario, we can even go up to 12 or 13. But I think that's where we are going to be. But after that is when I think the problem really will start biting us, because I think after that the growth will become stagnant, because as I said, even in 2019, the growth had slowed down to 4%. So all those structural problems have gotten further aggravated now. And unless those get addressed, I think growth is just going to come back from 10% to 5 or 4% and sort of remain stagnant at that level unless there is a tremendous push from the government to revive the confidence of the private sector so that they start investing again. So short of that, I have a relatively more pessimistic scenario about the medium-term growth outlook of around 4%. In terms of potential growth, I think 8% is quite optimistic. I think given the huge shock to resource allocation that has happened and given the structural vulnerabilities, I think potential growth would be around 5%. And for us to go back to that, yes. So I think for us to even go back to that will take about 3-4 years, if not longer.
Okay, that is very sobering. I'm going to
also, just one more point on that is, we have actually had a trend growth slowdown from 2011. So potential growth actually has been slowing down already for 10 years. And over and above that, we got all this shock. So I think, yeah, 5%.
I think the audience questions are pouring in now. So I'm going to start turning to those questions. And I won't identify all the speakers, all the questioners. We'll send you the transcript, and I'll go through them in an order that I'm going to choose. So can you say something about the state of the public finances in the coming year or two, the fiscal deficit and so on?
So as I said, the fiscal deficit for this year looks like for the general government, meaning central and the state government together, and taking into account the off-budget borrowing, could be anywhere between 12 to 15% of GDP. Next year, subject to where the growth situation lies and what happens to, for example, tax revenues, what happens to disinvestment by the government, what happens to further debt capacity of the bond market, fiscal deficit will probably come down marginally from that level to around 7% or so, because there obviously has to be some kind of a revival because of the growth pickup or the output pickup. And then from then on, as I said, there are always two scenarios. You can have a pessimistic scenario where there is no fiscal consolidation that can be done. Growth continues to be dismal, revenues keep falling, and we can probably remain at that high fiscal deficit of 7%, general, or 8%. Or in the positive scenario, if we do have a growth pickup and the government manages to do fiscal consolidation, increase tax revenues, then we might come down to about 5 or 6%. But I think the fiscal condition of the government will remain strained in the medium term.
Okay. And next question, what will be the impact of the agricultural sector reforms?
That's a good question. So what we are seeing, so I think the agricultural sector reforms were quite encouraging when they were announced, because the market, so to speak, where the middleman plays a very important role, that was proving to be quite a bit of an obstacle between the farmers and the end consumer. And with the new reforms, it's possible that the role of the middleman comes down significantly and the farmers are able to directly sell to the consumers. But what we are seeing is that the farmer community is, of course, not very happy with it at all, because I think the way they are interpreting is that the minimum support price, which is the price at which the government procures food grains from the farmers, is going to be a problem, because they will not be able to sell at the minimum support price anymore. And at that point, the farmers are thinking that they'll be worse off as a result of the agricultural reforms. So I think it's a good reform in terms of liberalizing the agricultural market and freeing it up. But to what extent this will provide a relief to the farmers? Is the private sector going to be procuring the grains from the farmers at a reasonable price? Or was the MSP structure something that could have been rationalized further? I think that just remains to be seen, because there are a lot of instances where the private sector seems like they're not offering right prices to the farmers.
Next question, any comments on the non-bank finance sector, particularly housing finance and auto finance companies?
The non-bank finance sector was, as I said, was severely impacted in 2018 as a result of the default of the large NBFC called ILFS, and has continued to be affected throughout the last 1 year or so. However, what has happened is there are a lot of steps taken by the RBI and the government to give liquidity support to the NBFC sector. So that has definitely helped those NBFCs which are highly rated. So the highly rated NBFCs are able to raise money from the bond market and from the short-term commercial paper market. So I think they are in a relatively better situation right now. What might happen going forward is we have thousands of smaller non-bank finance companies. And we may see a lot of consolidations happening in that space, because I don't think so many NBFCs will be able to survive given the liquidity problems. And it's already underway. We're already seeing a lot of consolidation happen in the NBFC sector. So there's sort of a wedge that has been driven where the highly rated NBFCs are sort of better off. They're able to raise money and they're okay. But the not so good ones are doing a lot of consolidations. And maybe that's where we are headed. But the entire NBFC space sort of gets shrunk in terms of the number of players.
And speaking of consolidation, what do you think might happen in the banking sector? And a two-part question there, besides consolidation, is there any scope for technology improvements that could make the banking sector more efficient?
What we are now seeing is that the government is prioritizing consolidation in the banking sector in terms of merging several public sector banks with each other. I'm not sure to what extent that solves the problem, though, because when you have a bad bank and a bad bank and you add the two, they don't really become a good bank. Or when a good bank gobbles up a bad bank, the problems don't disappear. So I don't think the problems are really going to get addressed by this kind of a merger. What just happens is that probably the governance becomes a bit easier, because instead of, let's say, 20 banks that you have to manage and govern, you now have to manage 5 large banks. But going forward, we still have to fix the banking sector balance sheet problem that really has not been addressed. On the technology adoption, I definitely think that there is a lot of scope to adopt artificial intelligence, machine learning, and all the new age technology to further improve lending practices. But all said and done, I think banking is the kind of business where the commercial judgment of the banker himself plays a very, very important role. We can probably automate it to a large extent, and we should definitely, but there also has to be some room left for that last bit of commercial judgment to come in.
Okay, do you think the informal sector can recover, or is the goal really to modernize it and shrink it, and what will happen there?
Yeah, I think this is the trickiest of all questions. I really don't think the informal sector is really going to recover or go back to where it was before all of these troubles started. Because as I said, it's not just the pandemic. The informal sector has been struggling at least since 2016, the demonetization, then the goods and services tax, then the Nbfc crisis, and now this. So I think they have been really badly damaged. And many enterprises in the informal sector will just have to shut down shop. They now have labor problems, they have credit problems. So while the government is trying its best, but I think the scale of the problem has been brewing for such a long time that it's going to be very difficult for the informal sector to really get revived. Formalizing, of course, is much easier said than done. I mean, as you know yourself and many in the audience, the informal sector size is massive in India, and formalizing them, given their fundamental structure, is extremely challenging. I mean, many of them they know how to use a mobile phone and a WhatsApp, but that's not really called formalization. So I think it's going to be very challenging. So one pessimistic scenario is that as a result of the pandemic and the structural problems, inequality in India becomes more severe. So we'll probably have, two sections of the population in two different ends of the spectrum. So-called the proverbial Indian middle class sort of gets affected, and the informal sector doesn't really get back on its feet. Because I think the formal sector will benefit a lot more, or will be able to revive from the pandemic much faster. So yeah, I'm not as optimistic about the informal sector, unfortunately.
So actually, those were the easy questions based on technical economic issues mostly. I'm going to turn to some questions which touch more on politics and political economy. What about tensions with China?
I honestly don't have an expertise to comment on this at all as an economist. I almost don't even follow the news as much, because frankly, I don't even know what's really going on. But
what about the trade and technology side of that with China? So not the border issue, but the
So I think there are many things that have been happening. So on one hand, the government has announced that we want to become self-sufficient, what they call the Atmanirbhar package. We want to become self-sufficient, and we want to look inwards. We want to make in India and all of that. But on the other hand, we are also inviting foreign investment. And on one hand, we are sort of curtailing exports to China or curtailing imports from China. We did ban a lot of imports from China, especially of apps, digital apps, etc. So I really don't know where we stand on that. And it's very difficult to really make out what the government stance is. But I definitely think that there is a great opportunity for India to capitalize on any gap that is created by China in the export of goods and services map of the global economy. So if there is any kind of withdrawal by China from that export landscape, I think that's a tremendous gap that India has an opportunity to fill up. I mean, if countries like Bangladesh can export textiles to that extent, I'm sure we can also do the same or better. But I think that's somewhere we haven't really performed very well. So I don't know bilaterally what we can do with China, but I think we probably can benefit from China's withdrawal from the international trade scenario.
Any comments on the political economy of economic policy making in India?
You're really taking me into very interesting areas, as I can see from the boring technical economic stuff. Well, all I can say is that I do see, and maybe it's difficult in every country. You know, we are not really in a scenario where any country is doing well as far as economic policy is concerned. So we don't even have a benchmark to compare ourselves against. But I think there seems to be a lack of a coherent economic strategy in India to deal with the short-term crisis, and also to sort of go in the next few years, what is going to be the medium-term outlook. I don't really think there is a lot of thinking, there's a lot of coherent strategy in terms of the economic policy is concerned. I do see the central bank doing a lot on its part, but I frankly do not see as much happening from the central government. And there I don't really know what is the thinking, what is the discussion and debate going on, given the extent of the crisis that we are facing. Maybe this year there is no policy maneuver, as I say, policy room to maneuver, as I said, but what is the outlook going forward? What is the plan going forward to address some of the structural challenges? I really don't see any kind of policy dialogue on that front. And that does get me worried at times.
Okay. And again, this is a little bit, beyond our expertise as economists, but do you see any positive developments on the public health side, or are they just going to let the pandemic rip through India and take it as a
so that's a very good question. So I think there are countries like Sweden which have basically said that we'll just let the pandemic run its course, but they do have a really world-class public health system and they can afford to do so. I think we are saying the same thing, except we don't have the public health system to deal with the crisis. But also, I think we are relatively more prepared today than we were in March, April, May, when the pandemic had really started getting severe in India. And I think our hospitals and doctors and the nursing staff, everybody was completely unprepared, unequipped to deal with the health crisis. I think now that 6 months have lapsed, we are more prepared to deal with it, I think, in general, with greater awareness of the public, of the medical staff, of everybody involved. I think relatively speaking, we are better prepared. But in general, I don't think our public health system is anywhere close to dealing with the extent of the crisis. But the silver lining of that is, as I said, it's possible we are going to be reaching herd immunity faster and quicker than many countries, for example, the US. And also, as I said, maybe it's possible that Indians have a genetic cross immunity to this kind of a disease, because as you can see, the death rate has been really, really low. And that is definitely a sign of encouragement. We are not really seeing hospitals getting overwhelmed with high death rate. And that probably is because we just live in a fundamentally unhygienic environment where we are exposed to more pathogens. And that is working in our favor right now, making us more immune to this kind of a virus. So I think that's the silver lining that I can think of.
Another political question, but really the economic implications. Will it matter who gets elected US president in November?
I think it does. I think it definitely does affect us. If not, I mean, I can't point out the concrete ways, but in an abstract level, if the current party in the US gets reelected again, it definitely has an impact on what might happen in the psychology of the political leaders of India. Because there is a lot of similarity in the policies and the attitude and the strategies adopted. And if that, it's almost like a reinforcement or the validation of some of the things that have been going on. So I think it definitely matters to a large extent. And also, I think, secondly, in terms of globalization, something that India could benefit from, but depending upon who wins the US election, I think globalization in general will have a big effect, and that indirectly will affect India as well.
Actually, back to a technical economic question, which is right in the center of your expertise. What's going to happen with inflation? Is there any way out? Can the RBI help with supporting the economy without raising inflation expectations and inflation?
I think inflation, most people, most economists in India would not agree with me on this point. I'm sort of a lone stander, I think. I think inflation is a serious problem. I don't think it is a temporary concern which is just triggered by supply constraints that will go away. I don't think it is. I think supply constraints in India will stay and they're not going to get resolved soon. And also inflation expectations have already been rising, which is a bit worrisome because as we know from the post-global financial crisis period, exactly the same thing had happened. Inflation has started increasing. RBI was late in reacting. And by the time expectations got entrenched, RBI had to do 2.5 years of monetary tightening to bring inflation down, which proved very costly for us. So I think we're almost headed in that direction because RBI also seems to think it's a temporary problem. And that seems to be the general consensus in the country. So I really don't think that we really have inflation under control. Although we do have an inflation targeting framework now, which we didn't have last time. But there is also a lot of talk about diluting that inflation targeting framework, a lot of discussion about whether we should look at financial stability and everything else and not just focus on inflation. As you know, we have not even been able to appoint a monetary policy committee because the new members did not get approved by the government, all the 3 new members. So we are sort of in a limbo for the first time, I think, in history of inflation targeting, perhaps, that there's an MPC meeting that had to be postponed because we don't have a committee. So I think the inflation targeting framework's credibility is at stake, and that worries me even more about RBI's capability to lower inflation. Having said that, I don't think the RBI can really do much in terms of reviving growth because, as I said, its policies are hitting roadblocks and limits at every level. I mean, liquidity injection, cut of the repo rate, on everything that the RBI is doing, I think monetary policy has reached the limit. So I really don't think that monetary policy can do a lot.
That's interesting because there was a question earlier which I'd missed about the slowness in appointing the Monetary Policy Committee, and perhaps that is not the worst thing that we have to deal with. Question about supply constraints. Will the supply constraints be resolved as COVID subsides? Is there some hope there?
No, I don't think so because, as I said, many of the supply constraints date back to the pre-COVID era, particularly the credit supply constraint. I mean, while we have had a massive collapse of credit demand, but I think in general, the banking sector and the bond market have become extremely risk averse given the crisis of the last few years. And because of the risk aversion, the banks have become extremely careful in their lending because the attitude in India was that much of the bad loan crisis was because of the banks' malpractices in lending and crony capitalism. And the banks were severely penalized as a result of that. So I think generally banks have become very risk averse to lend to the private sector. And that is unlikely to go away anytime soon. Also because we don't have a bankruptcy law right now, which is functioning, debt resolution is going to get significantly delayed. So all of that magnifies the supply constraint. Supply constraint is not just because of the pandemic. So I think unlike other countries where once the pandemic recedes, the supply constraints get resolved, I don't think that's going to happen in India, particularly in the credit space. In the labor space, we are seeing migrant workers coming back to the urban areas. So maybe that problem will get resolved faster. But the credit availability and the risk aversion in the financial sector, I think that's going to continue for quite some time.
How long is quite some time?
I don't know, Nivika, because as you know, the last time we had the high NP of 2015 and we thought everything is going to disappear and we'll grow out of the crisis in the next 2 years. We never grew out of the crisis. In fact, the growth rate fell. Now with the potential growth rate of 5%, a contraction of GDP, we are not going to be growing out of the crisis. So the denominator of the bad loan to total loan is not going to grow. So I really can't say how long it's going to take. It depends upon whether the government brings back the insolvency law, expedites the debt resolution, recapitalizes the banks so that banks are able to take the haircuts. So all of those things have to happen now. I mean, it's that urgent, but I don't sense that urgency in the policymakers.
So out of the 4 things you mentioned in one of your concluding slides, would you say that fixing the financial sector is the absolute top priority?
Absolutely. I think I would modify it to say fixing what I was calling the twin balance sheet crisis. So fixing the private corporate sector balance sheet, which is the debt resolution part for which you need the bankruptcy law, and therefore relatedly fixing the banking sector balance sheet. I think that's just absolute priority right now. And we can't afford to delay that any further But unfortunately, I think what's happening is with RBI's restructuring, we have again gone back into the delaying mode, and we're expecting things to sort of correct on their own. But yeah, I completely agree. I think that's the most important thing that we need to address.
Yeah. I think we're coming to the close, but what I did want to say is I don't think you're alone in many of the things you've said, including inflation. I think Urjit Patel, the former governor of the Reserve Bank, would agree with you. I think what you're saying is not that different from what Sajid Chenoy has been saying. You know, he's what, chief economist of JP Morgan, is that correct?
That's right.
Or, yeah.
Yeah.
And I think, nevertheless, I mean, what you're I think suggesting is that the government, well, I hope I'm not putting words in your mouth, is that the government really needs to listen to people like this who have some specific guidance in terms of policy making. Do you see any light on that end?
Not really. As I said, I don't see the government engaging a lot with economists and professional economists or academic economists who can advise as to how to go forward. I really don't think that engagement is happening quite a bit. So while there is a lot of commentary and a lot of discussion that's happening in media and other forums, I don't really see the engagement with the government happening. So I think that detachment has happened. The government is doing its own thing. And while it does talk to, I think, some economists from time to time, but we don't really know what is the government's thinking, what is the strategy, because there is also a lack of communication. You know, we often get mixed signals from the government because some spokespeople say something, they say we are poised for a V-shaped recovery and the government is going to announce fiscal stimulus. But the next day we see the government is not planning any further borrowing in the market, which means the government has not planned any stimulus. So I think forget about clear communication or a strategy. We are getting mixed signals from the government, and that itself is quite problematic. So I definitely think government would benefit by listening to several economists who have a lot to say and with backed by data and evidence. But one can only hope that that's exactly what happens going forward.
Well, keep up the good work. I think given the importance of the Indian economy and the fact that it's actually, if it's not already, it's soon going to be the most populous country in the world. And I think what happens to India is going to be very important for the global economy. I can't thank you enough for kicking off our series. I think today we've talked about risks more than anything else. Next week, we'll look at innovation, and then following that, we'll also have talks on financial inclusion. So I hope, I don't know if you'll be able to attend any of the other talks late at night, but again, thank you so much. Thank you to all the participants. I'm sorry if I missed any questions. We'll try and answer them offline. And it's just been a fabulous session. I think even for somebody like me, I learned a tremendous amount from your presentation and your responses to the questions.
Thank you again, so much. Thank you.
Thank you, everyone, and hope to see you all next week. Bye.
Thank you. Bye-bye.